How big of a reduction are we talking about this time?
Well, so this time around, it looks to be about 125 managing director positions, so more senior positions than in previous rounds, and also some of them in the investment bank. And this after Goldman already cut some in Asia, and as JPMorgan also cuts 40 positions here in the US, having already cut some investment banking jobs in Asia. So you can see a familiar pattern here, right, Sherry? It's also treacherous out there because this is the third round of layoffs for Goldman within a year. Goldman has already so far announced in 2023 3,325 job cuts. Morgan Stanley has announced 4,600. Citi has said it's cutting about 1% of its total staff. So it's the worst year since the banking crisis for banking jobs, which is a long time ago at this point. We already saw it in tech. You can tell the reasons why. I mean, the Fed has been raising rates. They're talking about 500 basis points of rate raisings, which has chilled the environment for deals. And it's not just coming back. That's the problem. In the second quarter, we have JPMorgan projecting another 15% drop in investment banking revenue. And that's not good for shareholders of banks, and it's not good for the banks themselves.
You know, Vonnie, it feels like just yesterday that we were seeing that fight for talent, right, with banks out incentivizing each other to hang on to staff. Why are they so content right now to get rid of talent if there is an anticipation that we'll return to deal making at some point?
Well, exactly, Heidi. It's so strange. It's unlike banks, especially in this environment when the quit rate is low and so on, to get rid of top talent. But the bottom line is the most important thing. And it looks like this return to deal making, this return to the fever that we might have seen at some point during the pandemic, is being pushed out. It might even be into next year now before we see those deals being done, those IPOs being announced, those mergers and acquisitions, and even capital raises. Companies are a little bit less content to do a debt deal or a capital deal than they were just a few months ago before the Fed started raising rates. Spring is traditionally recruitment season, of course, as well. So banks are probably thinking, well, we can cut now. We can even cut again in September, according to some reports that Goldman Sachs is thinking, and hire in spring. That said, some of the more boutique investment banks potentially are taking advantage of this putsch, if you like. And we have Perella Weinberg, for example, cutting overall headcount by 7%, but also specifically saying that they're hiring the top talent. We have Moelis & Company also saying it's taking advantage of this particular environment in order to not poach, but pinch, maybe is the right word, some of the top talent off the street.